You're listening to the Capital Stack podcast, brought to you by BWE's Arizona Team, bringing you the latest in capital market and lender news for commercial real estate. I'm Sarah Milley, and I'll be filling in for your host, Ryan Dencha. And now for the latest market news for the week of June 6th. The long-awaited FOMC May meeting minutes were released a little over a week ago, which indicated more rate hikes that are likely to go further than the market anticipated. The report indicated that officials are prepared to move ahead with multiple 50 basis point interest rate increases. All participants reaffirmed their strong commitment and determination to take the measures necessary to restore price stability. Federal Chairman Jerome Powell stated earlier this month that it would require clear and convincing evidence that inflation was coming down to the Fed's 2% target before rate increases would cease. Over the past 3 trading sessions, Treasury markets have held in a relative state of steadiness after the sharp rise in yields experienced since March. Yields had a second consecutive weekly drop as investors seeking safety jumped into Treasuries, with the sell-off occurring in riskier assets. Renewed inflation concerns have caused Treasury yields to buoy up by the most in more than 3 weeks. The benchmark 10-year Treasury rose approximately 11 basis points since Friday's close and is currently 2.91%. Since March, the 10-year Treasury yield has gained approximately 148 basis points to its peak level of 3.2% a few weeks ago. Now for up-to-date lender news, kicking off with life companies. Life companies continue to grapple with market conditions as pressure mounts on corporate bond yields, causing spreads to widen due to relative value. As indicated in past issues, life companies compare the yields on real estate lending with more liquid investment in single A and triple B corporate paper that are receiving higher yields comparatively. Spreads remain in the range of 1.6% to 1.9% for attractive lower leverage loans. According to a report issued by CBRE, life companies accounted for 26.3% of closed non-agency loans in Q1 2022, up from 19.2% a year ago. The majority were permanent fixed-rate loans with an average term to maturity of 108 months. Although market volatility has played a significant role in activity this quarter, there is a significant appetite out there for life company lenders, and multifamily remains the hot sector as investors seek safe haven assets. And now, switching over to agencies. Agencies have undergone another pricing reduction to their grids that reflected an approximate 10 basis point decrease on spreads for higher leverage loans nearing their 80% LTV ceiling, and a 5 basis point decrease for deals that are in the lower end of their range at leverage of 55 to 65%. Fannie and Freddie are picking up steam this month as they've fared better during the recent market volatility. In addition, Fannie and Freddie are starting to become more competitive on acquisition financings, which the life companies have been winning. The agencies will have significant capacity for the remainder of the year as they have capacity left in their allocations. In addition, BWE's Capital Markets Group has recently produced research demonstrating we're not in uncharted territory. There have been numerous short-lived occasions above a 5% note rate for Fannie Mae 10-year with 9.5 yield maintenance structures in the past. While there has been a recent surge in Treasuries, spreads for 2022 are within the 13-year historical average, and the most recent spread is trending lower to being below average. Now shifting to the latest for the U.S. Department of Housing and Urban Development. Rates for the multifamily new construction loans are ranging from 4.4% to 4.5%. Refinancing loans for existing or stabilized new construction apartment loans are ranging from 3.7% to 3.8%. The queue for HUD production offices continues to shrink, resulting in more favorable timeframes for processing FHA insured loans. HUD provides a 35-year fixed-rate, fully amortizing, non-recourse, fully assumable loan option for existing and stabilized multifamily new construction projects. This loan is at 85% LTV or 80% LTV with cash-out option and allows for a more stable loan during volatile market conditions like today. Here's your quick market recap. Renewed inflation concerns have caused Treasury yields to buoy up by the most in more than 3 weeks. The 10-year rose approximately 11 basis points from Friday's close and is currently at 2.91%. Agencies have undergone another pricing reduction to their grids that reflected an approximate 10 basis point decrease on spreads for higher leveraged loans nearing their 80% LTV ceiling, and a 5 basis point decrease for deals that are in the lower end of their range at leverage of 55 to 65%. The queue for HUD production offices continues to shrink, resulting in more favorable timeframes for processing FHA insured loans. Thank you for listening to this week's Capital Stack podcast. For more information on what was discussed during this episode, reach out to BWE's Arizona Team. Contact information will be provided in the notes section.